Ever wonder how a company, juggles the complexities of healthcare but still manages solid financial results?
It's a tough balancing act for sure.
Well, today we're doing a deep dive into Premier Inc., ticker PINC. They're a big player in healthcare improvement, driven by tech.
Right. They sit at an interesting intersection of healthcare delivery and supply chain.
Exactly. And our mission today is simple. Unpack their latest numbers, that's the fiscal year 2025 results, and really importantly, their guidance for fiscal 2026.
We want to pull out the key insights for you, sort of the need-to-know stuff.
Let's jump right in. The overall message from Premier seems pretty positive, actually.
Yeah, surprisingly so, given some context.
Their president and CEO, Michael Alkire, he put it bluntly. I'm pleased to report that we had a strong finish to the year despite the contract renewal headwinds, which are now mostly behind us.
That's quite a statement, acknowledging those headwinds up front.
He stressed that revenue and profitability beat their own expectations for the year. So what's really driving that strong finish? You mentioned context.
Well, the why is key here. It seems the outperformance was largely down to better-than-expected results in their supply chain services segment.
Ah, okay. So that part of the business really pulled its weight.
It really did. It suggests that even with challenges, maybe like those contract renewals, the core supply chain engine was running strong enough to, lift the overall results.
Interesting. So supply chain services was the powerhouse here. Let's look at the actual numbers that show this strong finish. Q4 fiscal 25.
Yeah, the fourth quarter.
Total net revenue hit $262.9 million. And they specifically mentioned this was better than they expected.
Right. About $11 million better than their midpoint guidance. If you exclude the Contigo Health part, they're winding down.
That seems like a pretty decent beat for one quarter, doesn't it?
It does. It points to good execution. Now, you do have to note that Q4 revenue was down 12% compared to the same quarter last year.
Okay, so a year-over-year drop.
Yes, but importantly, it was actually up 1% from the previous quarter, from Q3.
Ah, so sequential growth. A recent upward tick then.
Exactly. It might suggest they sort of turned a corner right at the end of the fiscal year, some positive momentum.
Got it. And the full year, fiscal 25 total net revenue landed at $1,012.6 million, over $1 billion.
Significant scale there.
Now let's talk profitability. That also looked strong, especially using those adjusted figures.
Yes, the non-GAAP numbers.
Adjusted EPS for Q4 came in strong at $0.46. And they said this helped push the full-year adjusted EPS above the high end of their guidance range.
Which is always a good sign.
Now, we always see these adjusted numbers, adjusted EBITDA, adjusted net income, adjusted EPS. Can you just quickly remind us why companies use these and why we focus on them?
Sure. It's a good question. Basically, these non-GAAP or adjusted figures are meant to give you a clearer view of the core ongoing business performance.
Oh, so.
Well, they strip out certain items that might distort the picture, things like costs from buying another company, one-off restructuring charges, maybe some non-cash expenses like stock compensation.
So it's like removing the noise.
Exactly. It helps you compare performance period to period more easily, focusing on the underlying operational health. It's not perfect, but it gives a useful perspective.
Okay, that makes sense. So looking at that cleaner picture for Premier's Q4, adjusted EBITDA was $71.1 million, again, without Contigo Health.
Right.
And that was $9.4 million better than their guidance midpoint.
Another solid beat.
And adjusted net income, $35.7 million, also beating guidance by $4.7 million. It suggests pretty tight control on operations and spending.
Yeah, it points towards good financial management. Absolutely.
Okay, moving beyond profit. Cash flow. How did they do there? That often tells a deeper story about financial health.
It really does. And here, too, they reported better than expected numbers.
Full year net cash from operating activities was $417.8 million. And free cash flow hit $180.5 million. Again, both better than they'd anticipated. What does that level of cash generation tell you?
Well, it screams financial strength, really,
Yeah.
and flexibility. They ended the year with about $83.7 million in cash. But maybe more importantly, they only had $280 million drawn on their big $1 billion revolving credit facility.
Wow, so tons of borrowing power left.
Exactly.
Yeah.
Over $700 million available. That gives them enormous flexibility for, whatever comes next. Acquisitions, investments, handling economic bumps, whatever. It's a strong position.
A very strong position. And they've been using some of that financial muscle to return cash to shareholders.
They have, quite actively.
They finished up a big share repurchase program, $800 million worth. under a $1 billion authorization that just expired in June.
That's a significant buyback.
Plus, they paid out $77.4 million in dividends over the fiscal year, and they've already declared the next quarterly dividend, 0 to 21 cents per share, coming in September.
Right. So you see both buybacks and dividends. What does that mix, especially the large buyback, signal to you?
Well, the big buyback often suggests management thinks the stock is undervalued, it reduces the share count, boosts EPS, it's a sign of confidence.
Confidence, exactly. And combining that with steady dividends shows a commitment to shareholder returns while, as we saw, keeping that balance sheet very healthy.
Yeah, and it's fascinating, as you said earlier, how they managed all this, the strong finish, the cash returns, despite those contract headwinds they mentioned.
It really circles back to that supply chain services segment performance, doesn't it?
Yeah.
It seems to be the bedrock allowing them to navigate challenges and reward shareholders.
Okay, so that covers the strong performance in the rearview mirror, fiscal 25. But what about looking ahead? Let's dig into their forecast for fiscal year 2026.
Right, the guidance. This is always crucial for understanding management's expectations.
How should we think about these forward-looking numbers?
Well, just remember, they are forward-looking. They're based on Premier's current view, their assumptions about the market, their strategy. It's their best guess right now.
A roadmap based on today's information.
Precisely. And like any forecast, things can change. Also, keep in mind this guidance excludes Contigo Health, since they expect to wind that down by the end of calendar 2025.
Right, focusing on the ongoing core business. So for the full fiscal year 2026, what are the key ranges?
Okay, for total net revenue, they're projecting $940 million to $1 billion.
So potentially flat to slightly down compared to FY25's $1.01 billion?
Potentially, yeah, reflecting maybe the full impact of those contract changes or other factors. Then adjusted EBITDA is guided between $230 million and $245 million.
Okay.
Adjusted net income in the range of $110 million to $120 million.
And adjusted EPS.
Expected between $1.33 and $1.43 per share. And they anticipate diluted weighted average shares between 81 and 83 million, reflecting those buybacks.
Got it. And did they break down the revenue guidance by segment?
They did. For supply chain services, they see net revenue between $590 million and $620 million.
Still the lion's share, clearly.
And for performance services, again, excluding Contigo, the range is $350 million to $380 million.
Looking at those two ranges, supply chain seems relatively stable, while maybe there's a bit more of a range or uncertainty in performance services, or perhaps opportunity.
That's a fair reading. Supply chain is the anchor. Performance services might have more moving parts, but also potentially more upside if their initiatives gain traction. And this guidance rests on some key assumptions.
Like what?
Well, for instance, they expect net administrative fees, a big part of the GPO revenue, to be $520 to $540 million. And interestingly, that includes $65 to $75 million from non-healthcare purchasing.
Non-healthcare, so they're using their buying power outside of hospitals too.
Seems like it. It could be universities, hospitality, other sectors. It's likely a diversification play, leveraging their scale.
Interesting. A way to maybe smooth out bumps in the core healthcare market. What else?
They also expect $70 to $80 million from software licenses and support within supply chain services that points to the tech side.
Higher margin stuff, presumably.
Likely, yeah. And on the spending side, about $80 million in capital expenditures. And they're aiming for strong free cash flow conversion, 70% to 80% of that adjusted EBITDA figure.
So continued focus on efficiency and cash generation.
Exactly. That seems to be a core tenet.
They also gave a peek at the first quarter of fiscal 26.
Just a quick look, yeah. Q1 total net revenue, excluding Contigo, expected between $230 and $245 million. Adjusted EBITDA, $45 to $50 million, and adjusted EPS, $0.27 to $32.20. Gives you a sense of the starting pace.
Okay. So connecting all this guidance, it feels like they're setting expectations for maybe a year of stability and execution after navigating those headwinds while positioning for future growth.
I think that's a good way to put it. It's a roadmap factoring in their strategic shifts. And that brings us to, well, what are those key strategic drivers behind these numbers?
Right, because the financials don't happen in a vacuum.
Exactly. First, let's talk Contigo Health again. The decision to wind it down by year-end 2025 is strategic.
Why? What does shedding that business do for them?
It likely streamlines the company, allows management to focus resources on the core, potentially higher margin or more synergistic businesses. It removes a distraction or maybe an underperforming unit, so excluding it from guidance gives a clearer view of that go-forward strategy.
Makes sense. Focus. What else are they highlighting strategically?
They're putting effort into reinvigorating performance services. They mentioned meaningful momentum in their advisory business.
Right, they signed 4 large deals and have a strong pipeline. That sounds promising.
It does. The key questions are, how quickly does revenue from those large deals actually show up in the results? And is this kind of advisory growth sustainable?
Good point. Large deals can take time to ramp up. Sustainability depends on keeping that pipeline full, I guess.
And on delivering value, right? Healthcare systems need help with efficiency and strategy, so the demand is there. Premier needs to keep proving its worth.
What about innovation? That's crucial for a tech-driven company.
Absolutely. They highlighted acquiring Illumicare. The goal there is to strengthen our ability to deliver real-time insights at the point of care.
So better data for doctors and nurses making decisions.
Essentially, yes. Integrating that tech could make their performance services offerings stickier, more valuable, but
There's always a but with acquisitions, isn't there? Always. Integration risk. Can they mesh the technology smoothly? Can they get their hospital members to adopt it quickly? And can they actually, monetize it effectively to justify the purchase price?
all fair questions. It sounds good strategically, but execution is key.
It always is. If they pull it off, it enhances their value proposition significantly.
Okay, and finally, back to the powerhouse, supply chain services. They noted continued demand from members needing margin improvement solutions.
Which is no surprise given the pressures hospitals face: costs, reimbursement issues, potential tariffs.
Right. And they specifically called out their pharmacy and food portfolios as key differentiators within their GPO. Why those two specifically?
Well, think about hospital spending. Pharmacy is a huge, complex, and rapidly growing cost center. If Premier has a really strong offering there, it can save members serious money. That's a big draw.
And food seems less critical than drugs. Maybe less critical clinically, but it's still a significant, consistent operating expense with its own supply chain complexities. Finding efficiencies there adds up. So having strong, specialized programs in both pharmacy and food, alongside medical supplies, gives them a more complete GPO offering.
A broader toolkit for members looking to cut costs.
Exactly. It makes their GPO more attractive compared to competitors who might be strong in one area but not others. So this raises the big question, doesn't it? How do all these pieces, revitalizing performance services, integrating Illumicare, leveraging these GPO strengths, how do they all work together?
Yeah, how do they connect to actually drive the revenue and profit they're forecasting, especially with all the industry challenges?
It seems like they're aiming for an integrated approach, right? Use the strong, stable supply chain business as the foundation,
The cash cow, basically.
pretty much, and then use that foundation to invest in and grow the performance services side, making it more valuable with things like Illumicare's real-time data and stronger advisory.
So the services help the hospitals operate better, which maybe makes them more loyal GPO members.
That's likely the idea, a virtuous cycle. The more value Premier provides through services and tech, the stickier their relationship becomes, potentially leading to more supply chain business or higher retention.
It's about embedding themselves deeper into the hospital's operations, from buying supplies to improving performance.
Precisely. That integration is key to minimizing customer churn and maximizing the value they get from each member relationship, which ultimately drives that profitability and cash flow they're guiding towards.
Okay, so let's try to wrap this up. The core message seems to be Premier finished fiscal 25 stronger than they thought, thanks mainly to their supply chain arm.
Right, navigating those headwinds successfully.
And they've laid out a clear, if perhaps somewhat conservative, plan for fiscal 26, built on stabilizing the core while investing in strategic growth areas like performance services tech and advisory.
Yeah, it's a picture of resilience and focused strategic moves. And it really underscores that looking at these financial reports isn't just about the numbers themselves.
It's about understanding the why behind them.
Exactly. Grasping the strategy, how the company is adapting, what levers they're pulling, seeing the bigger picture.
Absolutely. So here's a final thought for you to chew on. As healthcare keeps changing so fast, how well-positioned is Premier with its focus on tech and supply chain efficiency for the long haul?
That's the multi-billion-dollar question, isn't it?
And maybe what's the next big challenge or opportunity they'll need to tackle to keep beating expectations down the road? Something to think about.